Welcome back to the programme. We've got a great show for you tonight. Joining us in the panel is the independent investment expert Roger Montgomery. He's from rogermontgomery.com, and Tully Sacalerio. He's the CEO of Alert Trader. If you've got any questions you'd like answered by our panel, give us a call on 1300 30 34 35 or drop us an email at yourmoney@skynews.com. We're going to go straight into a caller. We've got Robert, who's been waiting patiently on the line. Hi, Robert. What's your question for the panel tonight?
Yes, good evening, Chris. Good evening, panel.
G'day.
I currently hold iSoft shares. I've been holding it for the last 2 years, and just noticed with the Henry Tax Review, it seems to favour iSoft, and I would like Roger's valuation perspective on iSoft.
I'm looking at some numbers here, and I must admit I'm taking a much longer-term perspective on this company. But if my ideal kind of business, the best types of businesses are businesses that you put a little bit of money in at the start,
yep.
They generate a profit, that profit grows, and you never have to put any more money back in, and the rate of return on the money that you put in just keeps going up. The return on equity, if you like, keeps rising. This is not one of those businesses. Now, it may become one of those businesses, but historically, if I go back to 2000, this company had shares on issue. It had, I'll just find them, bear with me, 170 million shares on issue. It now has over 1 billion shares on issue, 1 billion and 13 million shares. And it's raised a lot of money. In fact, the amount of equity that's been put into the business has grown from $81 million or $82 million 10 years ago to about $730 million last year. Now, so that increase in equity, and most of that increase in equity has come in the last couple of years, so far hasn't translated to very high returns. So it's a little bit like putting money in a bank account and not getting any interest. Yep. You know, what you'd like to do is if you put $1 billion into a bank account, or $750 million or whatever it is, you want to see you will see your interest go up if you put that money into the bank. Same thing in a company. You put money into the company, you're expecting returns to go up, because you can do that with a rocking chair in a bank account, quite frankly. But that hasn't translated yet, and in fact, the returns on equity for this company are in the range of 4 and 5%. In fact, 6% in 2009, 6% forecast for 2010, and you can get pretty much that rate in a bank account. As a result, the value of the business is substantially lower than the current price. So I'm not sure if we've got a price chart for this particular stock. If we can pull that up again, let's say the price is around 50 cents or thereabouts. Well, I've got a value of, yeah, there you go. It's a little bit higher than 50 cents at the moment. 58. 58. Okay, so I've got a value of 17 cents this year, going to 25 cents 2011 and 26 cents 2012. A long-winded answer to a short question, but at least it gives you some information about the company.
We had a couple of callers on yesterday talking about some of these mining stocks and the service stocks that are related to this. I mean, first of all, what's your view on the company? And I guess from an analyst type point of view, if you're looking at the resource super profits tax, how difficult is it to look at their future earnings when we really don't know how this is going to be affecting these sort of companies? Yeah,
it's a great question, and it's a question that I was thinking about today with some other people. And look, I think the government is going to actually raise the hurdle rate. I think that's almost a given.
To 11–12%.
Well, who knows what the number will be, but I don't think it'll be the rate that it is at the moment, or the bond rate. You know, that's just, there's no risk factored into that. So that will be seen, I suspect, as a positive. But for mining companies in Australia, the big issue is, look, let me summarise it very quickly, is Jim Chanos going to be right? You know, is his view about a property bubble in China going to feed through to a reduction in demand of raw materials from Australia? All the investment in China has been fixed investment. You know, a lot of the growth, that 8–9% growth that China's been reporting ad infinitum, has been input growth. So it's been fixed asset investment. It's been the construction of buildings and bridges and roads and those sorts of things. It hasn't been output. It's not, it's not the result of productivity of labour. It's not the result of inventions and innovations. And so at some point that has to change in order to be sustainable. There's 30 billion square feet of commercial property being constructed in China at the moment. That's 23 square feet for every man, woman and child in China,
Yep.
and I would argue that every man, woman and child in China doesn't need a 23 square foot office. There's already 20% vacancy rates in commercial property in China, and rental rates for commercial property have fallen a quarter in the last 12 months. So you know, I would argue that eventually the economics of constructing commercial property starts to become unattractive. People don't buy commercial property, developers stop building commercial property, and all of a sudden there's less demand for iron ore and glass and steel and concrete and all those things. So companies in Australia that have been riding on the back of the Chinese tiger, if you like,
yep.
You know, according to Jim Chanos, well, that may slow down.
That's, you know, a few years away, hopefully, if ever. That's the worst case scenario.
Yeah.
And, you know, he's a very affluent.
Just putting my hand up and saying it's something to be cautious about.
Yeah.
Yeah.
Well, how do you see MacMahon now? Have you got a value on that stock now for Abe?
Look, MacMahon is trading at a premium to its intrinsic value. I've got an intrinsic value of 41 cents, and that intrinsic value is expected to rise about 15% over the next couple of years. To compare that, you know, I would compare that to, say, Monadelphous, and Monadelphous has a similar increase in its intrinsic value over the next few years. Its intrinsic value is actually looking to rise by about 18% over the next couple of years, but it's trading at a slight discount to its intrinsic value. So given the choice between, and I'm not looking at it technically, of course, but given the choice of those two, and if I was forced to buy one of them, it'd be Monadelphous rather than MacMahon.
Yeah, I'm a big fan of Bradken, actually. Is that one that you've looked at?
Well, I can pull it up. It won't take very long.
BKN. That just came out with an earnings upgrade.
And when was that, today?
A few days ago.
A couple of days ago. OK, well, despite that earnings upgrade, its intrinsic value is rising a lot. It's rising 20% a year over the next couple of years, but its intrinsic value is closer to $4.90 than it is to the current price. Yeah, so it's a fair way away. So you buy it, I won't. We'll see how it goes.
So we'll come back in a month's time and see how we're getting it.
Let's come back in a couple of years.
Yeah, exactly. Yeah. Well, we're going to take another caller now. We've got Gary. He's from Perth. Hi, Gary. How's your question for the panel? Sorry, we've got Robert on the line. Sorry, Robert, what's your question for the panel?
Yeah, g'day guys. I'm just looking to purchase a company, Campbell Brothers, company code CPB. Haven't got them yet, but yeah, I'm looking to buy into them. What's your thoughts?
Well, firstly, I should say on behalf of all of us here, you know, don't take our word for it. Go and get some independent financial advice. We don't know your financial circumstances, so it's really important, very, very important that you understand that you know, we're talking about stocks, but it isn't advice to you to go and do anything. Having said that, look, the share price, where is it, $27 or thereabouts? That looks about right, $27. I've got a value on it of $14 currently. 2011. I've got that value going to $18.58 and then $25. So the share price today is higher than my intrinsic value estimate for 2011 and 2012. So it looks to be a little bit expensive at the moment. I should just add that it's not a bad quality business. It's a good quality business. Its quality has been almost, you know, second best in my mind about, you know, about what this business is like. And that's been fairly consistent since 2005, 2006. So it's been a good quality business for quite some time. But to have a good quality business and to make it a great investment requires, you know, a great price. So you want to buy a great business when it's available at a cheap price. And at the moment, the way I look at things, it doesn't have that second part, doesn't have the cheap price.
Wonderful.